The launch of California, in my view, is a transformative step for the Kenyan financial market. And in simple form, what is California? It's a benchmark rate which looks at and represents the average rate that banks lend or borrow on secured overnight funds in Kenyan shillings to other players in the industry. It brings about transparency, and you find out that this is at the global standard. We have it in the US called SOFR, we have it in the United Kingdom called the SONIA. So it's best practice, it reflects market liquidity, and it also brings about credit risk premium. So for us, we think it's a very good thing that the Kenyan government has embarked upon because of the transparency and the deepening of the market that rate brings about. So when you look at the Kesonia, typically is a base rate. And what banks typically do is to add what you call a credit risk premium, which is a K, or they call it, another operating cost. Now the question is, how do you determine credit risk premium? And for you to determine credit risk premium, there needs to be a credit ratings culture in any market that uses a Kesonia or uses overnight funds in this kind of way. So there needs to be a rating culture, and that's where we see a bit of challenge in the Kenyan debt market. There isn't a ratings culture. It's not as typical as what you see in South Africa or what you see in Nigeria, or in Cote d'Ivoire when we're talking about sub-Saharan Africa. So there's a problem there. Then the question we want to ask is, how then can a bank determine the credit risk if there's no credit ratings? And so for us, we believe that banks first need to have an internal scoring model whereby they're able to assess the counterparty risk, or what you would say an obligor risk rating, the credit worthiness of obligors. You need to be able to assess that. Banks need to be able to do that internally. They also need an external rating agency which will act as an independent party to verify the internal ratings that the banks have issued to complement one another. So first, where we see a challenge is in the area of the credit risk premium. How do you determine it? Because there must be benchmark. And one of the things that Kesonia, if you look at it in the United Kingdom, one of the things that's required is that banks must publish the weighted average premium to be able to, for customer comparison. So customers with lower risk must have a lower interest rate compared to customers with higher risk. And in the UK, they have to disclose that. You have to be transparent. So in their use of SONIA, which is similar to Kesonia, they have to do that. So one of the things we see as a challenge is that needs to be in place. The banks have to be transparent. They have to move from collateral-based lending to now look at entities based on their credit worthiness and their capacity to meet obligations. And so for us, that's quite critical. For the success of Kesonia, we need to have that in place. One of the other things we also believe beyond benchmarking is there must be availability of data. Because for you to be able to appraise, there must be data. If there's no data, which now is for data analytics, be able to forecast the performance of companies, then there will be a challenge as well. We also believe that it's important at this point that you have credit guarantee institutions, maybe like the Dana, whereby they're able to help banks lend to sectors such as weak SMEs that are perceived to be high risk, and then they issue credit enhancement. So all this is to deepen the market because of what Kesonia is going to demand from the market, which is more transparency. So if you look at every debt market, there are issuers, and issuers are entities that want to come and raise funding from the market. So they will issue debt instruments. There are also investors, like the pension fund companies who want to invest people's pension in those kind of instruments being issued. And they're the typical lenders, the banks. Now, what does credit ratings do? We have the buyers, you have the sellers. The sellers will tell the buyers what they want them to do. But what the credit rating does is an independent opinion on that particular instrument. So there's no bias towards the lenders, there's no bias towards the buyers, it's just an independent entity. And so the whole essence of ratings that you see in all the markets that have developed over the world is that they bring about that independence, whereby they're able to say this is the credit risk that this particular entity has. And if you, the buyer, wants to invest, then you must be aware of this credit risk. And it also helps in pricing. And what do I mean by pricing? If you are a low-risk entity, say, for better word, AAA, and you are an entity that is BBB, you shouldn't be borrowing at the same interest rate. Because a AAA is a better institution, a better run institution. And so what ratings does is also to help in pricing, whereby all the investors can say, because your risk is higher, I therefore demand a higher interest rate to cover me for the credit risk that I'm embarking upon. So ratings helps deepen the market. It brings the issuers, it brings the investors, and it brings about independence. So it helps deepen the market in terms of independent opinion, but it also helps in pricing. If not, what the banks and everybody will be doing is what we call, oh, I just look at it, then it's perception price. And you can't do perception pricing. No, it's a pension fund money. It has to be well rated. It has to, the risk must be recognized. So what I would say is that the rating agencies help in terms of pricing of instruments and also information asymmetry, to lower information asymmetry in the market. The first step is regulatory alignment. You need to recognize ratings, ensure that it's in the prudential and disclosure framework. In some markets, for instance, banks have to disclose their ratings in the financial statement, saying this is our rating. And you don't have to be the top of the investment grade. You can be even a speculative grade, but the truth is there must be transparency. So there must be regulatory alignment. For the market to deepen, it's important that the regulators recognize rating agencies. In Kenya, they've licensed two, ourselves and our competitor have been licensed. But beyond the licensing, there needs to be encouragement to make companies become more open, more transparent, and align and do ratings to help deepen the market. Also, what I would say is that one of the things that ratings does is to create awareness as to the kind of credit risk that a company has. And I'll give an example. We have funds in Nigeria, what we call money market funds. We call it collective investment schemes. And what the regulator has done is to ensure that those schemes are rated. And the whole essence is that for pension investors to understand the risk that those funds have invested. And because there are ratings, individuals, whether it's low savers or even high net worth individuals, everybody goes in understanding this is the rating of this particular collective investment scheme. And therefore, I want to go in informed. And for you to protect small savers, you need to ensure that collective investment schemes are rated. If not, people are giving institutions their money and they don't know what kind of instruments have been invested in. And if you look at, for an example, Nigeria today, they have about $2.9 billion in money market funds, and that's just one of the collective schemes. And it's because the ratings has helped grow that market. Investors are willing to put their money in because there's transparency, and ratings brings about transparency. Even the asset management companies realize that we have to subject ourselves to an independent party to look at the kind of investments that we're making. And because of this transparency, we're able to grow the market. So what I would say is there needs to be more regulatory alignment whereby the regulator is pushing for various, whether it's banks, the collective investment schemes, issuers of debt instruments to do a rating so that we bring about transparency and bring about more people to make the right investments. And one of the things I also like to say is that in every market, the banks cannot supply the funding need of companies. And why do I say that? Banks cannot lend long-dated. They can't do 10 years. They can't do 15 years, they can't do 20 years. That kind of funding can only come from the debt market. And in periods of stress, banks do not want to lend. You find that in periods of stress, financial stress, banks want to hold on their money. But that's not the case with the debt market. The debt market, the money is there, the pension money is there, long-dated, 25 years, 30 years. And you find out in South Africa and Nigeria, there are instruments of 25 years where manufacturing companies have used them to expand their infrastructure, to grow their capacity. But if you continue to rely on the banks cannot do that kind of tenor of funding. So what I say in my mind is for the Kenyan market to deepen, we must allow ratings and we must allow institutions to come to the debt market in their own capacity and not rely on the banks, because the banks cannot do longer dated funding. Kesonia credit ratings, credit guarantees are not isolated reforms. They are all complementary. And the whole essence is to grow the debt market, to make the market more robust, to make the market more transparent, to make it more reflective of market conditions in terms of the kind of interest rates, to reflect real-time funding costs, and create a reliable foundation for pricing across the financial system. So credit ratings will address the areas of the pricing. The guarantee institutions, what they do is to make institutions or sectors that are not bankable, make them more bankable, and make them for investors to have more confidence in them. So for instance, I would say the agricultural space, for instance, a lot of banks don't want to lend in that space. They're worried because of the high risk. The credit guarantee institutions make those type of sectors more bankable, make it more attractive for investors' money to come into them. And the investors don't have to be only local, they can be foreign investors as well. And when they know that there's a guarantee institution willing to pay, should there be any kind of issues with those agri players, that gives them comfort and that helps them as well. And of course, with Kesonia, the interest rate is more market driven. It reflects market condition. It reflects the current liquidity in the market. So I think they all complement each other and they all bring about trust. They all bring about deepening of the market. They all bring about transparency. And they all bring about the credit risk premium that we keep saying that if Kesonia wants to be very successful, then the credit risk premium will be clearly identified, must be clearly priced, and there will be a benchmark supporting it.